All right, guys. So in the absence of questions, let us go ahead. Now, before we go ahead, I want to actually applaud everybody here today for coming. Do you know how many of us started this class? Right? There were a lot of us that now we are like half, okay, for the physical class and then the Zoom class as well. Okay, is that way? You know, many are called, but few are chosen. All right, so you are the chosen one. So please clap for yourself, guys, for being here. Also on the Zoom call, guys, you're on the Zoom call, clap for yourself for being here. This is, I think this should be our 6th class. Yes, these are our 6th class. All right, and then we still have 2 more classes to go. All right. Now today, I want to talk about something very, very important. So today, I want to talk about entries and exits. Okay. Entries and exits. Entries and exits. Now, by entries and exits, we are talking about, okay, when price gets into your demand and supply zone, once price has taken liquidity, how do you now enter the market? What do you look out for before you hit the buy or sell? What confirmations do you want to have before you buy or sell? And also when you enter a particular trade, where do you put your stop loss and where do you put your take profits? Okay, so I want to talk about that today. Now, I'm very, very careful when talking about entry and exit because I do not want to limit our trading capability. All right, there are a lot of ways to take entries in the market. I must establish that. All right, and every strategy, every entry strategy that has an average win rate is working well. Now, every strategy will work better after liquidity has been grabbed. And we've established liquidity concepts. Now you have an idea about how the market grabs liquidity to move price in the original direction. All right. So if you are already a trader and you have been taking entries and then you have some sort of a working system, you can optimize your entries such a way that you are taking entries only after liquidity has been grabbed. Okay. Now, for the purpose of this class, I'll be teaching us possibly 2 or 3 ways to take entries at our point of interest. Okay. And as you go along, please know that you can formulate your own entry strategy. All right. As you get exposed to different concepts, as you get a better understanding of the market or price, it is okay if you reach a conclusion that, okay, you want to create an entry system that is custom to you. Am I communicating? Right? I'm saying that because for some of us, the things that you learn when it comes to entry strategy might not necessarily align with your perspective of the market, or might not even align with your personality. It might not be something you like to trade with. All right. That's why I'm saying that I don't want to restrict you to a particular way of trading. But when you get to a point whereby you're able to bring everything that we've learned together, and then you start connecting the dots, it will be very, very easy for you to formulate your own entry strategy. Am I making sense to anybody? All right. So just to say that in the beginning before I give you what you can trade with. So I'd like to categorize what you learned today as something that you can start with, okay, for taking entry. This is what I look out for when I'm taking entry. All right, but it does not mean that that is the only way to take entry at points of interest. All right, good. Now, today we're going to be looking at taking entries via All right. So I want to look at today. We look at headline. Sorry. Look at heads and shoulder pattern. Okay. We'll also look at trend line breaks. Trend line breaks with Fibonacci. Okay. It's on the bottom. Okay. So we'll look at these two ways you can enter the market after liquidity grab. And these two methods would also give you exit. So you know prices where you should put your stop loss and prices where you should put your take profit. Okay. And I also need to reestablish or reiterate what I've been telling us about the Forex market. There is no entry strategy that is 100%. Okay. Strategies will fail. It will also make you money. All right. Bottom line is that with consistency, your edge as a trader is if you find a strategy with a decent win rate, your edge is consistency, is continuity. Even if that particular, you are losing some trades, you want to stick to that particular strategy. Okay, that is your edge as a trader. So when you are trading a particular way and then you lose maybe 2 or 3 trades, don't give up and think that it is not working. Right? Because it is very, very easy for traders to want something that is 100%. There is no 100%. I need to establish that fact. All right. So today, I think what we might do today is to just focus on the schematic. So today we might not necessarily be able to go into how it looks like in the real market, looking at backtesting, but I want to really dwell on these things today, dwell on the theoretical part of this today. And tomorrow, our next class, we are going to do proper backtesting. So next class, we are going to look at the live markets, look at what has happened in the past, seeing what is going on in the demand and supply zone, and trying to make sense of it, how our entry strategy, okay, would have given us profitable setups in the market, all right? But today, I want us to understand this theoretically, all right? So that when I'm showing us in a live market, it will be easy for us to see what I'm saying, okay? So as always, I like to take things step by step so that we can understand it very, very well. Now, how many of us here still remembers our lesson on Fibonacci? Anybody? All right. If you are on the Zoom call and you still understand our lesson on Fibonacci, okay, type in yes in the chat box. If you don't understand the lesson on Fibonacci, type in no. So this is where we now try to bring everything together. Okay, Victor understands, Paul understands. All right. David, do you understand? Mr. Do you understand? How about you, sir? Sir, you understand our lesson on Fibonacci? Okay. Are you sure, sir? Yes, that's sure, okay. It's not note, I'm saying like the application. All right, so most of us on the Zoom call understands. Chineke said, I've not watched the record. Okay, so go ahead and watch the recording as soon as you can. All right, so we are going to be using our knowledge of Fibonacci to take entries. All right, who can remind us, right? What retracement numbers can we use to take entry? Okay. Can somebody remind us what retracement numbers can we use to take entry? Okay. If you are on the Zoom call, type it in the chat box. What real numbers? Okay, below 0.5. So so we have 0.5. Which one again?
0.236.
0.236.
1.7. 0.114.
0.5. 0.382. Okay. All right, good. So good. What extension numbers can we use for our take profits?
1.618.
1.618.
2.0.
2.0.
2.618.
2.618.
And 1.272.
1.272. Okay, good. So can somebody tell me, how do we measure if we are trying to, so this is it. So let's say we have a bullish environment here. How do we measure, or what do we measure using the Fibonacci? What are we measuring exactly?
We are measuring impulse.
The impulse, all right. So the start of the impulse to the end of the impulse, right? Because we want to get the end of the correction, so that we can take entry. Impulse there, correct? Good. I'm glad we understand that. Good. So now that we have all of that in check, let us move ahead. So let me start by talking about the heads and shoulder pattern. Now, when it comes to entry and exit, yeah.
It's because of my dad. Because we have together.
We are going to have a separate class. We can't go over Fibonacci again today. All right, it has to be another class. Well, were you in class that day that we learned it, or like you got the replay? I think it was because you didn't join the first class.
It was
So second one, yeah. So that's why. Don't worry, you get it. So heads and shoulder pattern. Let's do that real quick. All right, now head and shoulder pattern is a reversal pattern, or let's say is one of the strongest reversal patterns in the market. Okay. What is a reversal pattern? A reversal pattern is a pattern that forms when price is about to react. When price is about to reverse. That means if you see price moving bearish and there's about to be a correction, a lot of times you see reversal pattern form at the end of that impulse. So I'm saying if price is coming down like so, okay, and then let's say you want to see price go up. A lot of times, somewhere around here on a lower time frame, you're going to see a reversal pattern form. All right. Now, why do we want to use reversal pattern to take entry? Remember, if you are in a bullish market, okay, we are looking for entry in a demand, right? So your entry is to buy. So we are looking for a reversal pattern because we know that if a pattern forms and it's a reversal pattern, that pattern might initiate the move up. So we are looking for a reversal pattern in a demand zone after liquidity has been grabbed, all right? And then we want to leverage on one of the strongest reversal pattern Am I communicating? Okay, so that's why we are using the heads and shoulder pattern. So how does the head and shoulder pattern look like, and how do we trade this particular pattern? Okay, so there are two kinds of heads and shoulders, right? We have the bullish heads and shoulder pattern, and then we have the bearish heads and shoulder pattern, right? A bullish pattern will form, okay, at demand, and a bearish pattern is going to form at supply. Okay, so let me quickly draw how it looks like, and then we will explain how we should trade it. Okay, so let's start from bearish head and shoulder pattern. Okay, it looks like this. Okay. This is the head. This right here is the left shoulder. And this right here is the right shoulder. Okay. And we have something called a neckline. Okay, so let's quickly, if you can draw this on your notes, or you can just quickly take a screenshot so that you can move really fast. Now, head and shoulder pattern is made up of the head, left shoulder, right shoulder, and the neckline right here. All right, so this is pretty much an impulse. You see an impulse leg, you see a correction, and you see another impulse, a higher high coming down to this leg, retracement. This is a bearish head and shoulder. Now, bearish pattern means that this is a pattern that's going to form, right, when price wants to reverse to the downside. So when you are anticipating a move down, right, you want to be looking for a bearish head and shoulder pattern. Now, a bullish pattern looks like this. It's the same thing, you just flip it. So left shoulder. Neckline. This is a bullish head and shoulder pattern. So let's quickly draw that in. Okay. Now, when looking at this pattern, it's a structure. It's just, you see how the candlestick is arranged. It looks like heads and shoulder pattern. It's a pattern. And that pattern is based on market structure. Okay. So at what point do we take entry? What is the best point to take entry? Now, just like every other thing in the market, just the way traders are dynamic about how they take entry, this is a very, very popular pattern that fails a lot as well. Okay. It also has a very high record of win rate. Okay. Now, traders use this pattern and then they take entry at different areas. But I'm just going to show you how I like to take entry using this pattern. You can formulate or create your own entry as you deem fit. Okay. So I'm saying that because I don't want to restrict your creativity when it comes to entry or trading in the market. You can create your own rules. Please note that. Okay, if you've done proper back testing, you've done forward testing, and then it is solid, you can create your own rules about entries and then you stick to it. Okay, but just ensure that you are trading with a system. Okay, now, how do we take entry? What exactly are we looking out for? Okay, now, are we done with this page? Let's do a screenshot, right? Let's do a screenshot, it's best. Okay, we have to move forward. David, do you understand? Of course, you don't really sorry about me. This is just okay for you, isn't it? It is, because you're already trading. You are Mr. Olanwaju. So Mohammed, this is easy cake for you, right? You know it already.
Yes, I know it's the application.
All right, so let's move forward. How do I recommend that you trade? Now, please note, let me reiterate. These patterns will form at different zones in the market. The right zones you want to be trading this is either for a bullish pattern at demand zone, in a discount zone, after liquidity grab. As a matter of fact, let me write it down so that we don't get confused. Where do you want to spot a bullish heads and shoulder pattern? Okay. Where should you spot it? Okay. Where should you spot? So let's quickly do that. All right. You want to spot it at a demand range. Okay. After liquidity grab in a discount zone. Okay. And where should you spot a bearish head and shoulder pattern? At a supply range or in a supply range after liquidity grab in a premium zone. Okay, so that'll give us a bit more context into what we are doing. Okay. Okay, so let's talk about how we want to take entries on this guy. Give me a second. Please, if you have any questions along the way, feel free to ask your questions. It's very important that you understand these things properly. Yes. All right. So let's move forward step by step. Okay, we'll get there. Now,
So, not this copy, that is where she went for the building.
yeah, that's why I say you should take a screenshot. All right, we have to move faster. Okay, it's the same concept. Okay. Okay, so now let's talk about the bearish heads and shoulder pattern. Where do we take entries? Now, when you spot this pattern, at what point do you start looking for entries? And how do you look for entries? Okay, so this is it. Now, this is a bearish market. And in a bearish market, you are concerned about supply, isn't it? So this is your supply range. Have you? On that time frame, okay, this can be your refined supply somewhere around here. Okay. Now you would have waited for price to retrace into this. You want to spot activity of inducement, liquidity grabs. So I see this. And before I go forward, I must say, because it has happened to me a lot. Now, because I'm looking for certain all right. Let's put our phones on silent. On silent or vibration, please. So, what's I gonna say? Yes. Now, it's not every time that your entry criteria will be met in a supply or demand zone. Unfortunately, there are times that you might be waiting for heads and shoulders to form at a demand zone or supply zone, but it's not going to form. Right? It does not form every time, unfortunately. All right, because you are looking at the market from a perspective. It's not every time that the market will play to your rules. All right, so there might be times that you might be waiting in a demand zone to take entry, and then price will just kick off and go without you. All right, it's fine. That happens. All right, so it's not every move that you're going to catch, but because you have some set of rules and criteria, all right, it really help you make very precise and concise moves, which is highly rewarding at the end of the day. So in a supply zone like this, yeah.
If it happens like that,
Okay.
we forget about that move.
Yes, and then you wait for the next setup based on your entry system. So once price comes up like so, okay, you're not looking for heads and shoulder. Okay, something like this, you know, see. Okay. So this is your left shoulder. This is your head. It's your right shoulder. Okay. So after liquidity grabs is where you want to be looking for this particular pattern from. So,
sir, what I'm seeing now, it means the edge of the head shoulder is the end of the what is it called
impulse.
impulse. No, not impulse. What is impulse correction? No, this is downtrend move.
Okay.
This is the impulse. So the internal structure there is the correction.
Okay.
Then the impulse move. The other another impulse move again. So the edge.
You are trying to take entry,
Yes.
so that you can catch the impulse.
Yes, that's what I'm seeing now. It means let me come. So here now
Okay.
is the end of the correction.
Possibly.
The beginning of the impulse move goes like
Possibly. If
if
it's difficult, yes. Yes. Okay.
but it refers on M pattern before it forms.
You are trying to get liquidity first. Okay, before that happens. Okay. Now, possibly in later classes, we might also look at how to trade M pattern. Now, there are times that instead of head and shoulder pattern to form after liquidity grab, it might form just M. Okay, M in this case, or W pattern in terms of the demand. All right, but let's just stick to one for now. All right, that's why I said there are a lot of ways to trade the market. Okay, so this is a scenario that you're looking forward to, guys. It's as simple as this. Don't let's complicate trading. Okay, so let's now look at how do we take entry using head and shoulder pattern on a bearish heads and shoulder pattern. Okay, so when you have a market like this, price giving you retracing into your supply like so, and then you have something like this, price going down like so. Okay, it is when I have something like this that I will have started, because I'm anticipating a reversal already, right? I would have started seeing a possibility of a formation. Okay, even though it has not formed yet, this will be my possible. So this is a possible left shoulder, right? Abi?
Okay.
So now I'm now waiting for a possible right shoulder. Okay, so maybe price will not do this. Okay, so once I see this happen, once I see something like this happen, okay, you know that this is also now, so this will give me the formation of a neckline. All right, now I must say, guys, sorry I did not mention, let me quickly backtrack a bit. Your heads and shoulder pattern, now this is what I've shown you right now, is a standard head and shoulder pattern. It does not mean that this is the way it's going to be. It can be this way, it can be slanting, it can be this way. I don't know, I can move this to the side. I can't do it. It can be slant, right? It can be like this.
To the left or to the right.
Yeah, so let me do something like this. So it can be like this. Such that this would be neckline, and and then price keeps going like this. All right. So this would be the head. This would be the left shoulder. This would be the right shoulder. I don't know if you get my point. So it doesn't have to be straight like this. The markets will do whatever it wants to do. But you are looking for a pattern. If that pattern has some form of resemblance to your own pattern, right? You just take it, just take it short. So I was giving you as an example, how do we start spotting, looking for entries? Okay. Now, there are some people that will take entry at the formation of the right shoulder. There are some people that they will have started taking entry over here at the retracement. So once they see, so now one thing that I like to see personally is that this my left shoulder, this left shoulder here. When I draw this line, I want this impulse move to break this to the downside. So I want price to break this line here. Once that break happens, I'm now going to be waiting for the formation of a possible right shoulder. So this can be my right shoulder like so. Once I see a rejection like so, that will give me the possibility of a neckline forming. I want to take entry at the break of the neckline. So if price comes down, I'm looking to start waiting for my trigger once price breaks this neckline. So this is my neckline. My neckline is just simply what connects the end of this correction from the head shoulder and over here, the start of the impulse for the right shoulder. Okay, so that's a neckline. Okay. So once price breaks my neckline like so, okay, at any place it breaks, I now start looking for entry. So how do I, is this a bearish pattern or a bullish pattern?
Bullish pattern.
Look at your notes. Is this heads and shoulder a bearish heads and shoulder or a bullish heads and shoulder? Eh? So what are you doing in a bearish pattern? So you're looking for sell. Good. Victor, you're correct. So you're looking for sells. So how do I look for a sell? Once I see the break of this neckline, how I like to trade it is I want to consider the start of this impulse from here, okay, so to here. So if this is the end of this impulse move, once I start seeing correction like so, I now start measuring. So I want to pick the start of this impulse, okay, to this particular. So I take my Fibonacci and I measure from here to this down, all right? And then I'm waiting for price to retrace. Usually I like to do 0.382, but some will enter at 0.5. Some might choose to enter here or here. That's why I said you can enter at any point you want to enter. So personally, my entry point is at 0.382. All right, this is what I'm looking to take entry. All right, don't worry, I'll do it again so that you don't get confused. And then my stop loss is going to be at 0.114 or at this extreme, one or two pips above this zone. My take profit is going to be at maybe TP1 at 1.272 and TP2 at 1.618. Okay, and then you can keep trailing your stop loss. I'll take it again, don't worry. Is it clear to anybody?
It's clear, but
okay, I'll take it again. Okay, let me come again. Don't worry, we are going to understand it. We are doing only schematics today. Let me delete everything. So we are talking about how to, in a bullish head and shoulder pattern, how do you start looking for entries? Now, this is what we're talking about. This is our pattern here. Okay, this is our pattern here, like so. Okay. So at what point do we take entry once this pattern is forming? Now, it is before the pattern finishes forming that you would have looked for your entry. So this is what we're looking at. This is what it looks like. All right. So I want to, first of all, see a possible head and a possible left shoulder. Okay. So if you see something like this, all right, this is your left shoulder. All right. Once I start seeing something like this, because I'm already anticipating a reversal now, right? So, and I know that this pattern might form. Once I start seeing something that is resembling it, I'm at alert to start looking for the formation and then entry. So I want to see, this is my left shoulder here. This line, I want my head. This is the head. Okay, possibly I want price to come below this left shoulder line. So price should break below it. Once that break happens, right, that means the next thing is to see a possible right shoulder form, right? Good. So that right shoulder, it might stop here or it might go above. Doesn't really matter. All right. So when I see something like this form and then I'm seeing price coming down and it's getting, so this is a possible, this is now a neckline, have you? Correct? Now, my trigger for entry, I will start being very at alert to start looking for entry once price breaks this neckline here. Now, there's some people that at the break of the neckline is where they will take entry. All right, but that's not the way I like to trade it. That's why I said there's no one way to trade the market, guys. There are times that there are times that price will break the neckline like so, and then to just keep going down. So guys that entered at the break of the neckline would have been in the trade. All right, at the range. So, but let me just show you how I do it. You can customize these things to suit your own kind of person based on how you backtest it. Okay, make it your own. All right, but this is how I trade this pattern. So I want to see the break of this neckline here. So once that break happens, because I like to take entry using Fibonacci, okay, I'm not going to consider this whole move from here to here. That's my impulse move. Okay. From the start of this impulse to where price broke the neckline. So I'm concerned about that. Once I see that this move now is now retracing. Once I see little retracements, I now start using and I'll bring my Fibonacci from the start of this impulse to the end of the impulse. So I'll not be waiting for price. So if price keeps going up, I'm still waiting. All right. But my trigger is somewhere here. So this is your golden zone. Okay. Golden zone, your entry zone. Okay, your ideal entry zone is here. So anywhere in that zone is where you can take entry at the golden zone, which is between your 0.5 and 0.3H2. Now, when you do back tests a lot, you see that a lot of times price would usually go beyond the golden zone before going down. So there's some people that instead of taking entry at the golden zone, right, they will wait for price to come to the 0.236. That way they will have a tighter stop loss and a better risk to reward. Okay, So depends on how you want to trade it. That's why I'm trying to explain the whole system to you so that you can formulate your own. It would be wrong for me to tell you that this is the only way to trade in the market, right? That's why you are here in the workshop. We cannot all trade the same way. Please understand that. So I'm not trying to enforce a particular way of trading, because if you try it, it might not work for you. It might not just align with your person. Okay, so ideally, personally, I will set my pending order. All right, so when I see that price, I started retracing like so, I'll have gone to my MT5, set a pending order. In this case, I'll set a sell limit at this 0.382 price. That is 1.25990 is where I'll set my sell limit. Okay, and where I'm looking to exit, my exit is anywhere from 0.114 to 0. Entry, that's then exit. Exit zone.
Not facing.
Huh?
Not facing.
Yeah, stop loss. Thank you. Stop loss. All right, so you can put your stop loss anywhere in this zone. So again, depends on your threshold. Where do you want to put your stop loss? Is it exactly at those lines or a bit above, right? So you can be very as you wish, okay? And when you take entry at your entry zone, where do you take, where are your exit zones? Your exit zones are the extension numbers here. All right, I would also establish something very, very shortly. So anywhere from, you can take, these are your exit zones. Okay. From here, these are first exit zones. Okay. Am I communicating? Table of one zones, and then again, you are the one that will set how you want to exit. Now, there's some people as well that this is one. Some people might decide to take partial profit here. So once price gets to 1 on the Fibonacci, all right, you might decide to take partial profit. Okay. That's at the 1.0 Fibonacci zone. So once price goes up into my entry, I'd already set a pending order for a sell limit in this case. Who here knows about pending, or who does not know about pending order? Can I see your hands up? Wow.
I know, but it's used to come this times. Sell limits, buy limits.
Okay. That don't know about. Who else here don't know about pending orders? One, who else? If you are on a Zoom call, if you're on Zoom and you don't know about pending orders, okay, type in yes in the chat box. Okay. All right, so that means most of us know about it on the Zoom. Paul C is asking a question. You're asking a question, is any tool for taking partial profits on MT4 or MT5? Well, there are some indicators that can do that, but you can even do it by yourself manually, right? So if you click, if you have a running trade on your MT5, for example, you just click on that running trade, click on close profit, click on close trade, right? And then you want to change the lot size. So if you have a running trade and your lot size is 0.1, that's a mini lot.
No.
You can take partial profit by you not change that is 0.1 to, let's say, 0.03 or 0.04. So it's only close trade of that particular lot size. So you take partial profits and then you leave the rest to run. Another thing that you can do if you don't want to be doing that is to do what we call twin trading. Right? Twin trading means you are opening multiple trades at the same time with different take profits. All right, so let's quickly do a brief recap on twin trading. Okay.
On different lot size.
Yes. Twin trading. Okay, so what is twin trading? Or see, listen, all right, I think you know this already. Now, twin trading is simply, all right, so if you're based on your risk management, you are supposed to, on this particular setup, you are supposed to use a lot size of 0.5 lots. Okay, that's on one position. Now, if you want to do twin trading, you now want to open multiple positions such that the total of those positions is going to be 0.5 lots. So if you can now open, let's say 2 or 3 trades. So if you're opening 2 trades, for example, or 3 trades, you open one trade can be 0.2 lots. Another one can be 0.2, and then the other one can be 0.1. Okay. Now, why are you doing twin trading? Because let's say you have different take profit zones. So based on your trade, you can choose to exit at different levels. So your first position, now all of these trades, okay, let's do that. They are going to have the same stop loss, okay, but different take profit. Make sense? Same stop loss, but different take profit levels. Okay, so that when price gets to that different take profits, these trades will be closed themselves automatically. All right, so that way you won't have to be doing partial profit. So if you're supposed to take a partial profit at one here, you would have open a position using this zone as your take profits for that particular position. Is that clear? So that's what twin trading is. You are just breaking your trades, trades into multiple positions. Okay. Hosi, I hope that makes sense to you. Okay, let us move forward because of time. All right. Yes.
The question I want to ask, you advise us that you are not forcing us to follow your own way of trading. But please, what makes you to be taking your own to enter?
Okay.
Taking your entry at that 0.382.
Yes.
What are your reasons?
It's just based on back testing. I've seen that price usually taps in there a lot. All right. There are times that I will lose trades because price will just stop at that 0.5. Okay, but more times than often, more times price would find a way to get to 0.382. Even though it goes beyond it, but ultimately it will go in my direction later. So when you backtest, when you look at how the market has played out over time, you would arrive at an understanding. So you derive something from backtesting. So this is my own derivative from backtesting. A lot of times I see, and if I put my entry at 0.382, it gives me a tighter stop loss. For example, let's do an example. Okay, if my stop loss is at 0, okay, and I'm taking entry from 0.5, from 0.5 to my stop loss is let's say 9.4 pips. But if I take entry at 0.382, instead of 9.4 pips, my stop loss will now be 7.3 pips. So if I take entry at 0.382, my reward on that trade will be much more. Okay, so let me make it clear a bit, okay? So it's clear, right?
Yes, it's clear. But the reason why I'm asking this question is,
Okay.
Is that in your previous lecture,
Yeah.
we talk about premium listing and refine zone of taking listing. So that 0.382 has not gotten to refined zone. And
go ahead.
If you have patience, so it got to, so your risk is will still be
lower.
Yeah, that's
so I can also recall saying now all of this that you are doing is on a lower time frame.
okay.
Remember that you had also got your refined zone on the higher time frame. Okay. And I can recall saying something that there are times that price will not get to your refined zones. Especially on a lower time frame. It might not get there sometimes. Sometimes it might get there. So you can wait for price to get your refined zone. So that means you'll be taking entry at maybe 0.236 or 0.114. So at the end of the day, it depends on how you want to trade it. All right, but on a lower time frame, I like to use the Fibonacci to take entry. If price reverses into my refined zone, I can choose to take another entry and add to my position. Okay. Chineke is asking a question. Please, asking what is the advantage and disadvantage of swing trading? Well, I don't know if it depends on you. It's what you want to do or how you want to trade. All right. Personally, I don't do so much of swing trading. All right. I open one position and I manage my positions. All right. So that depends on what works for you. If swing trading works for you, okay, you do it. I don't see any disadvantage yet for swing trading. All right. And there's no pretty much, the only advantage is that with swing trading, you can get out at the set take profit levels. Because there are times that if I open one trade and I'm trying to take partial profits, sometimes I'm not on my chart, I might miss a level to take profits. Okay, but if I'm opening multiple trades with swing trading, even if I'm not on my MT5, the trade already closed in profit. Okay, so that's one major advantage of swing trading. It's the same thing like overbought.
And maybe, as you said, 0.2.
Yeah.
1.
Yes.
Let's say the 0.1 is the last one is the take profit 3.
Okay.
And if the take profit 2 has been taken.
Taken.
So maybe unfortunately the yes, reach the take profit.
Also, yes,
So it reverse. So the loss that we have is
The less.
it's not there as you open one trade of 1 point.
that's very correct. And I also recommend, if you are doing swing trading and if price hit your one take profit, okay, try and move your stop loss to break even. Move your stop loss to break even to like secure your trade. So it's now a risk-free trade for you. Okay. So this is how I look at the market when I'm taking entries. It is not, I must repeat, right? I'm not teaching you a system that works 100%. I don't know a system yet that works 100%. Or Mr. David, do you know a system? Maybe if you know.
Yeah, involved in it. I know it.
Please tell me. All right. So what you want to focus on is trading the plan. Focus on data. Yes, sir. You have a question.
Absolutely.
Pending, yes. I asked those who know pending orders. So what I'll do, sir, you are in my beginners class. Right. I got pending orders. You were in the class too. I did. All right. So what we'll do is buy stop, sell stop, buy limits, sell limits.
Selling limit and the buy limit is reversal.
Yes. All right. So for those of us that don't know about pending orders, just remind me on the intermediate group. I'm going to send a graphic that will help us learn it, or I'll just send a replay of the beginners class on pending orders. All right, it's quite easy to understand. So back to our analysis or analogy on how to take entry using this bearish head and shoulder pattern. So you take entry at the entry zone, and your entry zone can be anywhere, guys, as long as it is in the premium. All right. Anywhere above 0.5 is a premium, right? So it's safe to take entry anywhere. You can choose to also take entry at the refined zone on the lower time frame for the supply. Although there are times that price wouldn't tap into your refined zone, but it's fine, right? So however you want to trade it, it's up to you. All right. So I'm glad that we understand he has a very, very important question, right? You can choose to not take entry at 0.382. You can choose to take entry at your refined zone, which might align with 0.114 or 0.236. Depends on you. So do your back testing. Your back testing will help you itemize or know the zone or the right entry price for you. All right. So that will also help you optimize your trading system to give you a better risk to reward. Okay. Yes, sir. You have a question?
Yes, and sometimes it said you can break even. That is within our
Sorry.
stop
To break even, yes.
to break even. Is that patterns. Explain that that.
Okay, so we have a question in the house. Let me quickly do that about moving stop loss to break even. It's very simple. It's just simply changing the value of your stop loss. So if you take entry, so let's say you are buying, okay, you want price to go up. If you are buying, this is where you put your stop loss. Your stop loss is down. Okay, so let's make that red. And then this is your take profit, somewhere at the top. Let's make that green. Okay. Now, if you click on buy and then price is going your direction, and then it has hit a particular zone, so that price does not retrace against you and then go and hit this is your stop loss. Moving stop loss to break even is simply you now go to your MT5, you modify that order, and then you change the value of your stop loss. So your stop loss, you now move your stop loss, you now use this price. So this is now your stop loss. So that means if anything happens and the price goes against you, you just have broken even. So you don't make profits, you don't make a loss. Yes. So that is moving stop loss to break even. So it's simply moving your stop loss to your entry price. You can also add your spread to it. Okay, so if your spread is, let's say 1 pip or 2 pips, move your stop loss 2 pips above your entry so that your spread is covered for. Okay, that is it. So it is now a risk-free trade. You can trade with peace of mind. You can let your trade run. Okay, good. So do we have any questions in the house or on Zoom about entry and exits with this bearish heads and shoulders using our Fibonacci? Any questions on this, guys? Look at it properly. Do you have any questions at all? So let me use this tool. This is, so I will take entry here. Okay, so we have stop loss, and then this will be possible levels of take profits. Do you have any questions, guys? Yes. Do you have any questions? Any questions on the Zoom? If you understand and then you're on Zoom, type in I hear on the chat box. Let me know if you understand. If you don't understand, type in not yet. Hey, sir, you have a question?
Yeah, what you just explained now about the moving the stop loss.
Yes.
But it works when or if your trade has been making has made some what is it called
Profits, yes.
If the profit are not getting to certain thing, it will not work like that. It will be rejecting the moving of the stocks.
Yes, definitely. The only time you do that is when you are in profits. Okay, so price has to be above that zone.
But I'm trying before, so it doesn't.
Yes. So how you do that depends on how you want to manage your trades. So it is a concept under trade management. Do you want to move your stop loss to break even when you are 20 pips in profit? You can choose to make it mechanical by pips, or you are using structure. If price gets to, let's say, a pip level, or if price gets to a particular demand or supply, or an internal structure of supply or demand, I want to move my stop loss to break even. Okay, so it's all of these things, you are the one that will decide how you want to do it. Okay. So personally, the only time that I would consider moving my stop loss to break even. So on a sell scenario now, like so, it is when price gets to this one. Okay, once price breaks this particular structure, once price breaks this particular structure and gets to 1, right, is when I'll consider moving my stop loss to break even. All right, and I can even decide to take some partial profit. Okay. We have a question here. What is the name of the red and green tool? Okay, so it's a short position tool. Okay, it's called short position. It is under forecasting and measuring. Okay, so this is long position, this is short position. I'm accurate. It is under forecasting and measuring tools. So short position is for sells and long is for buys. All right, so it's a measuring tool, it's a forecasting and measuring tool. So easily, if I'm trading a particular set of and then I already have an idea of my stop loss and take profit. I can know easily my risk to reward. So right now, based on this measuring tool, I know that my stop loss is 7 pips, and then my take profit is 41 pips. So it will also give me my risk to reward ratio. So right now, my risk to reward is 5.9, 1 to 5.9. So I'm risking, let's say, $1 to make almost $6. So that means I'm making much more than I'm risking. So it just gives you more perspective into your trading setup. Okay. Let's move forward, guys. It's almost 1 p.m. Okay. So let's do for a bearish scenario. Are we for a bullish scenario? Yes. Are we all taking this screenshot? Remember, you are taking entry using the Fibonacci retracement, and then you are taking exits in terms of take profits with the extensions. Stop loss also the retracement numbers. Okay. So let's do for a bullish scenario. It's on Pulse. It's on TradingView. On the now for all of us that don't know how to use TradingView, on all of the videos, the links to the replay classes, the first video on that particular playlist is how to use TradingView. So I did a particular masterclass on how to use TradingView, how you register, how to know all the tools and all. But right now, Pulse, this tool function, it is on a platform called TradingView. And over here, where you have your tools, you see it's forecasting and measuring tools on the left-hand side. Okay. I mean, okay. Forecasting and measuring tools is where you see it. So click on the arrow, you see long position for a buy and short position for a sell. Okay. So there was no other tools there that you might need, but that for later. Huh? I don't explain how to use it. You have a stop loss. You have an entry. So we have a question here. How do you use this tool? Based on your setup, you have an entry, right? You have stop loss, and then you have take profits. Good. So you just simply, so let me delete it. So if I now want to measure it to see that trade, I click on the tool. You want to put it, where are you entering? You put it on your entry. All right, and then you adjust it to where your stop loss is. So this red part is stop loss. This green part is for take profit.
Okay, you extend it.
You extend it, yeah. So it gives you an idea of.
It's as if we start Fibonacci.
Yeah, it has nothing to do with your trade. It's just for you to see what's going on, like a measuring, forecasting. Sorry? And it also gives you your risk to reward ratio easily. Right? You don't have to use it for your trades, but it helps you know your potential gains on that particular setup. Okay. So let's really do a bullish scenario. A bullish scenario. So for a bullish scenario, we're looking at a structure like so. So our price is going up. So you want to buy at demand, right? So this is a demand range. All right. This can be your refined demand forever. You wait for price to retrace. When price gets into your demand zone, okay, wait for liquidity grabs. You are looking for demand pressure or buyer's pressure. Yeah. Yeah. So once price breaks the zone, you're not looking for a head and shoulder pattern. So left shoulder, your head, okay, right shoulder, and then you look for buying opportunities. Make sense? This is the head, left shoulder, right shoulder. This is the neckline. So let's see what we're talking about. The AC is too much, and I'll reduce it. Okay, so for a bullish pattern, we have something like this. So when price starts giving you this inside a demand after liquidity, because you're already expecting something of reversal. So once you see this, and then you see something like this, okay, that should be your first cue, because this is a possible left shoulder. So you are going to be anticipating the formation of the pattern. All right, so it's not going to form at the same time. So you have to be on it to till it forms, and then you take entry. Okay, so you might have something like this. So this is your left shoulder, possible left shoulder, possible head, right? And then I'm really concerned about, if it is a head, then I need it to come above this, my left shoulder head. So I want price to break the zone, like so. Okay. Once that break happens, can I see a retracement? Okay. So once I see something like this, that means I'm about to anticipate a possible right shoulder, right? Then this will give us a neckline. So it can be straight. Let me use straight this time. Okay. So my entry is to anticipate the break of this neckline. So if price comes up and breaks this zone, okay, it confirms this as my, what is this place called? Right shoulder, right? Good. So once that happens, and I see the break of this neckline, Linda, are you cold? You are still cold, are we?
Yes, sir.
Should I put on the AC? No. Because the highest is 30. 30 is like heat. At 30. Okay. Let me answer. Okay. So we are looking at this. The break of this neckline, like so. Now, this is when I start considering entry. How I like to do it, I'm considering the start of this impulse move to where, so if I see start price is already giving me some form of retracement, like so. I'll now start considering this high. So what do? I take my Fibonacci, those are fibs, I measure from this place to this place here. Okay, so I'm looking to enter. Okay, this is my entry zone. My entry zone, this is my stop loss zone. Okay. So first tip profit zone can be anywhere from 1.272 or 1.618. You can even make this your TP1, TP2, depends on you. Okay, so first check profit zone. So however you want to trade it is fine. So trade what works for you. And anywhere up, so everywhere is actually take profit zone, right? 2.0. Mind you, you can take profit at any of these extension numbers, all right? If you are trading your stop loss, these are psychological levels in the market. These are also reversal areas in the market. Okay. So you can use your TP1 here, TP2, TP3, TP4, whatever. I mean, if you have 100 TPs, you can use the zones on your TP zones. So ultimately, I'm now waiting carefully for price to retrace into here. So that's a pending order for a buy limit. Or you can choose to enter instant execution and wait for price to get there. So for some people that like to take entry using candlestick confirmations, there are some people that they like engulfing candles, or they like to see hammer, you know, or some spinning tops and stuff. So some people would like to wait for price to come here, and based on the character of the candlestick that form at that entry level, they now go ahead and take entry.
But is it very advisable that we should wait this formulation of the business? We should wait for the time.
You can. You can, yes.
But I've actually seen from that entry and
Yes.
goes down to stop loss, fast stop loss, and then the platform. Most times I don't seem to be fast.
Yes. So
Then, sir,
yeah.
with the formulation of the head and shoulder, does it mean that the head and shoulder sign has a liquidity this thing for the?
Sometimes it does.
Because if I should get to right in this drawing,
Yes.
this previous drawing, so the head and shoulder serve as
This one, I mean,
yeah.
this drawing, okay.
Yes. Yeah, because the W listeners forms
Okay.
before the head and shoulder now form. So the head and shoulder will now serve as a liquidity to the W pattern
Yes.
before the move.
I'm not sure I get your question, but over here, people's stop losses are here, right?
Yeah, yeah.
Okay. So price has gone down. Some people, they will also be induced here in a bit to believe that price wants to go up.
Yes.
But people's stop losses will still be taken out.
Yes.
Ultimately, there will be a lot of injection in the market to move price up. And because this pattern is one of the strongest reversal patterns, a lot of times, if it forms after grabs of liquidity, it is going to align.
Okay.
Now, this pattern forms, it can even form here. Instead of this W pattern now,
Yeah.
you can see a head and shoulder pattern. But because you understand how it works, you will not be taking entry.
Okay.
So you wait for that pattern to form and for people's stop loss to be taken out before you look for your own pattern, next pattern to take entry.
In case if
Okay.
it's formed.
Yes. It's just that the most popular that you see is this double top, this double bottom and double top, okay, in a demand and supply zone. You can also see head and shoulder pattern be used as inducement.
Okay.
Okay.
Then if the head and shoulder
Yes.
is used as the inducement,
Mhm.
what pattern will you be expecting after as?
Same head and shoulder pattern.
Okay, same here.
Yeah, because not every pattern fails. All right, like I said, the patterns, you have a better chance of trading patterns that form after liquidity has been grabbed. All right, so you are more likely to win that trade, to profit in that trade, because there has been previous stop hunting. So there's no reason to really, stop hunt anymore, because they have enough volume to move price up. Okay. Yes, sir.
That reminds me of part of the question I had in mind to ask
Before, okay.
In your teachings or explanation about this liquidity
Yes.
stuff, and you said if the retail traders
Yes.
enter a trade
Okay.
or some trade, the big institution will will take their we take the what is it called? Their stock loss entry
Okay.
before they will now move the
Price up. Yeah.
and you made mention of saying there will be enough volume for them to move the market.
Yes.
Does it mean that if that's where my question?
Okay.
Does it mean that if the small retail traders not take the trade,
Yes.
the big institution will not be able to move the market?
Yes, because like I said, that's why we explained economics in nutshell. When buying and selling happens at the same time. All right. If small traders don't take the inducement, remember we are an ecosystem. We have hedge funds trading here. We have banks trading here. There are even sometimes that it's not only retail traders that will be induced.
Okay.
All right. Even some major corporations as well will be induced as well to think that price will reverse here. All right. So anybody can be induced. All right. So please know that when you are losing money as a retail trader, it's not only you that are losing money, even big corporations, hedge funds are also losing money. So it's a very competitive market. It's a battle of price. Yes.
My further question.
So yes, so if liquidity is not grabbed, you will not see strong moves in the market. Okay. So there has to be that inducement, because if price wants to go up, right, that means there's a demand for that thing. Okay. All right. So how will there be demand if there's no supply?
If there is no one,
how do you buy if there's nobody that wants to sell to you? How do you sell if there's nobody that wants to buy from you? All right. So your understanding of that simple concept will let you know if you should be buying at a particular price or not. It will help you know when the real moves in the market will happen.
The reason why I asked the question, because when I was watching the video, when I really understand what there. So I now think of saying it means, sorry, I missed my question.
Go ahead. Guys, if you are on the Zoom and you have questions, please feel free to signify. I'm going to unmute you and you can ask your question. But now we have people in the physical audience asking questions. I believe you're also hearing them and I'm answering. So you can also ask your questions and everybody will learn from yours. Okay. Yes, sir, go ahead.
As you tell us or advise us
Yeah,
that we should be patient enough
yes,
before we enter a trade. We should be patient for the liquidity to
Yeah.
be cracked
yes.
before we. If every traders
Unfortunately,
Does it
not every
have to-
trader will be patient enough, because you must also know that we are trading on different time frames.
yeah,
And then there are times that price will even go without grabs of liquidity.
yes,
It's not every time that there will be liquidity grab
yes, yes.
in a zone, but most times, majority,
Okay. And the security and
not everybody will believe that something is right,
yes.
all right?
Um,
Some people believe that Tinubu is savior, right? Some believe that it's Peter Obi. We cannot all be thinking the same thing in this life.
even if you are seeing the person.
Yes,
We-
we can't all think the same way. All right?
Yes. Thank you so much.
Yes, sir.
I have a question.
Yes, sir.
Do you back?
No problem, sir.
The previous job
The previous
and the previous lecture,
lecture, okay?
you are into like, you are telling us that she took I actually after the.
As in crowd.
How do you know when?
Yes, so that's what we talked about 2 classes ago. So class, then we don't talk about it last class. So if you are buying, at what point do you buy?
I buy
At demand zone, right? Good. So in a demand zone, once price retraces into a demand zone. So let me show you on the chart. Just look up so that to be more practical. So we have a question here in the class. Someone is asking, how do we know when liquidity is being grabbed? So in a bullish environment like so, we've established this a lot. This is a demand range, right? So you're looking for activity in that demand range. Okay. So spotting liquidity grabs in a demand is spotting inducement and buyer's pressure. You want to see pressure from people. You want to see that people are buying this thing. So, and a lot of times we are going to see a reversal pattern form. In this case, a double bottom or a W pattern. So you see something like this happen. So once you see this happen, this is buyer's, you can see this impulse move here. Okay, that's buyer's pressure. Okay, it also broke structure. That means a lot of people are putting their stop loss below here. So spotting liquidity grab means that when you see price come down to take out stop loss, that is a liquidity grab. All right, because people were induced into believing that price will start going up from here forever. But ultimately, price went up a bit, all right, came down, took out people's stop losses. This is liquidity grab or stop hunting. Is it a bit clear, sir? Yes, sir. So that's how you spot liquidity grab. Okay. Do we have any more questions in the house or on the Zoom? Let me call our names out. Chineke Alex, any question? David O'Brien, any question? Kano Mano, any question? Amakiri, do you have a question? Paul C, do you have a question? Victor E, do you have a question? All right. So now, because we are out of time today, we won't talk about the second entry system today. We'll talk about it in next class. The second entry system is the trend line break system. Because like I said, it's not every time that this pattern will form. So if this pattern doesn't form, there's another thing that you can look out for, okay, to take entry. after liquidity grab. So we'll look at that the next class, and we also do back testing as well. By back testing, we'll go on the chart and see how these things has played out over a period of time. Then after we've done that, our last class, I'd like us to really deal with risk management, money management, and psychology properly. Okay? No questions, okay? All right. So I'm going to do my possible best to upload this video today. Please, if you don't see this video before 6 p.m. today, please disturb me in the group. Thanks to Mr. Mohammed. It doesn't let me rest.
No, I'm hoping to your problem.
Okay. So yes, no questions. All right. If you have any questions as you are studying, feel free to ask your questions on the group or bring it to the next class, and then we'll deal with your questions. Yes, Kanu Manuel, I will send everything shortly. Okay, so you'll see it shortly. All right. So guys, let us end this session. I'll see us possibly our next class as it stands is going to be next week Monday, but I'll let us know if we can hold a session on Friday. Okay, because we have a physical seminar at our office at 10 Trade in Lagos on Friday, right? And I would also be part of the facilitators of that seminar. All right, so we might not be able to have our next session on Friday, but definitely next week, Monday, we would have our session. All right, good. So let's have a remarkable weekend. Yes, so today is Friday, right?
Yes.
Our next class will be on Monday. Yes, on Monday. Good. On Monday, yes. So I'll see us on Monday then. Okay, let's have a good weekend. And please watch the replay. Watch the replay. I'll be seeing everybody in your dreams this night. If you don't watch the replay, I'll see you in your dreams.
In spirit.
In the spirits, yes. All right. I'll see you on Monday, everybody. God bless you.